Welcome to Swift Dividends to Financial Freedom. Today, we're embarking on a journey to explore dividends, a valuable tool in the pursuit of financial freedom. Imagine a stream of income that flows into your bank account without you having to lift a finger. This is the power of dividends. But what exactly are dividends? In its simplest form, a dividend is a portion of a company's earnings paid out to shareholders. If you own shares in a company that offers dividends, you stand to receive a piece of the company's profits. It's like getting a slice of the pie without having to bake it yourself. Dividends are a key player in the financial world for a reason. They provide a steady income, which can be especially attractive in times of economic uncertainty. Moreover, they can be reinvested to purchase more shares, leading to an even greater return over time. This is the magic of compounding, a powerful force that can significantly grow your wealth. Now, it's essential to remember that not all companies offer dividends. Some prefer to reinvest their profits back into the business for growth. However, those that do offer dividends are often mature, stable companies with a track record of profitability, and owning shares in such companies can be a significant step towards achieving financial freedom. Before we move on, let's take a moment to hit that like button and subscribe to this channel. This way, you won't miss out on any future content designed to guide you on your path to financial freedom. As we delve deeper into this topic, remember, understanding dividends is the first step towards financial freedom. Dividends can be a powerful tool for wealth generation. Let's dive into the world of dividends and discover why they hold such power. At its core, a dividend is a portion of a company's earnings distributed to shareholders. It's like a thank you note from the company saying, "Hey, thanks for believing in us, here's a piece of our profit." But the real magic begins when you choose to reinvest these dividends. When you reinvest dividends, you buy more shares of the company. This means that next time the company gives out dividends, you'll get a bigger slice of the pie, because you now own more shares. This cycle, known as compounding, is like a snowball rolling down a hill. It starts small, but as it rolls, it gathers more snow and grows exponentially. The power of dividends lies in their potential for long-term wealth accumulation. It's not about getting rich quick, it's about steadily building wealth over time. And the best part? You don't need to do anything. The compounding happens automatically if you choose to reinvest your dividends. Now remember, dividends aren't guaranteed. They depend on the company's profitability and the decision of its board of directors. But companies that have a history of paying dividends are often stable and financially healthy. They're the kind of companies that can help you build a reliable income stream. Dividends can also provide a buffer during market downturns. If the value of your shares falls, dividends can help offset some of these losses. They're like a steady stream of income in an otherwise turbulent sea. So what's the takeaway? Dividends, when reinvested, can create a powerful compounding effect. They can provide a steady income stream and help cushion against market volatility. They're not a get-rich-quick scheme, but a tool for steady, long-term wealth accumulation. By harnessing the power of dividends, you can lay the groundwork to achieve financial freedom. And remember, the earlier you start, the more time you give your dividends to compound and grow. It's never too early or too late to start building your path to financial freedom with dividends. Now you might be wondering, where do dividends fit into my investment portfolio? Well, dividends play a crucial role in a balanced investment portfolio. They can be your ticket to financial stability and growth. But how? Let's dive in. A balanced portfolio typically includes a mix of different asset classes such as stocks, bonds, and cash. The goal is to spread your investments across these different types of assets to manage risk. This is what we call diversification. Think of it as not putting all your eggs in one basket. Now, dividend-paying stocks can be an important part of this diversified mix. They can provide a stable income stream that can help cushion your portfolio during market downturns. When other investments might be losing value, dividends can continue to generate income. And let's not forget about the power of compounding. Reinvested dividends can buy more shares, which in turn can generate more dividends. Over time, this can lead to a snowball effect, potentially increasing the value of your investment exponentially. Moreover, companies that consistently pay dividends are often well established with stable earnings. They can be less volatile compared to growth stocks, which can add a layer of stability to your portfolio. But it's not just about stability. Dividend-paying stocks can also offer potential for growth. As a company grows and increases its profits, it may also increase its dividends. So you can benefit from the dual advantage of income and potential capital appreciation. However, It's important to note that not all dividend-paying stocks are created equal. It's crucial to carefully evaluate each potential investment to ensure it aligns with your financial goals and risk tolerance. Incorporating dividends into your investment strategy is like adding a safety net to your portfolio. It can provide a steady stream of income even in volatile market conditions and help you stay on track towards your financial goals. Remember, a balanced portfolio isn't just about managing risk, it's about optimizing returns, and dividends can play a key role in that. Incorporating dividends into your portfolio can provide a steady income and reduce risk. So, how do you choose which dividend stocks to invest in? Well, there's no magic formula, but there are a few key metrics that can help you evaluate the potential and reliability of a company's dividends. These metrics include the dividend yield, payout ratio, and dividend growth rate. Let's delve into each of these to give you a better understanding. Firstly, the dividend yield. This is probably the most straightforward metric. It's simply the annual dividend payment divided by the stock's current market price. It's usually expressed as a percentage. For example, if a company pays out $2 per share annually and the stock price is $40, the dividend yield is 5%. The higher the yield, the more dividends you'll receive for each dollar you've invested. However, a high yield isn't always a good thing. It might be a sign that the company's stock price has fallen due to problems within the company. So, it's important to look at the yield in context with other factors. Next up, we have the payout ratio. This is the percentage of a company's earnings that it pays out as dividends. It's calculated by dividing the annual dividends per share by the earnings per share. For instance, if a company has earnings per share of $4 and it pays out $2 in dividends, the payout ratio is 50%. A lower payout ratio can indicate that the company has plenty of room to maintain or even increase its dividends. However, if the payout ratio is too high, it might mean the company is not retaining enough earnings for growth, which could endanger future dividends. Last, but certainly not least, is the dividend growth rate. This metric shows how much a company's dividend has grown over a specific period. A steadily increasing dividend growth rate can be a positive sign, showing that the company is thriving and is able to share more of its profits with shareholders. However, like with the other metrics, it's important to consider the bigger picture. A company might increase its dividends to attract investors, even if its earnings are not keeping pace. So again, context matters. By understanding and considering these key metrics, dividend yield, payout ratio, and dividend growth rate, you can gain a clearer picture of a company's dividend reliability and growth potential. It's like having a compass in the world of dividend investing. It won't tell you exactly where to go, but it can help you navigate and make informed decisions about which dividend stocks to include in your portfolio. Remember, investing is not a one-size-fits-all game. What works for one investor might not work for another. Your financial goals, risk tolerance, and investment horizon are all factors that should guide your decisions. By understanding these key metrics, you can make informed decisions about which dividend stocks to include in your portfolio. And that's your stepping stone to financial freedom via swift dividends. Like any investment, dividend stocks come with risks. Venturing into the world of dividend investing can seem like smooth sailing. After all, who wouldn't want a regular income stream just for owning a piece of a company? Yet, as with any investment, there are potential pitfalls that we need to be aware of. One of the most significant risks is a company cutting or even eliminating its dividends. This can happen when a company's profits take a hit, or when it decides to reinvest earnings back into the business rather than distributing them to shareholders. When this happens, the income you were relying on can vanish in an instant, leaving you with less than you anticipated. Another risk is the potential for a decline in stock prices. If the market loses confidence in a company, the value of your stock might plummet. This can lead to a double whammy of reduced income and a drop in the value of your investment. So how can you mitigate these risks? Diversification is key. Just as you wouldn't put all your eggs in one basket, it's unwise to stake your financial future on a single dividend-paying stock. By spreading your investments across a range of companies and sectors, you can reduce the impact if a single company cuts its dividends or its stock price tanks. Careful stock selection is another crucial strategy. Look for companies with a strong track record of paying dividends, as well as solid financials that suggest they'll be able to continue doing so. It's also a good idea to keep an eye on a company's dividend yield. That's the annual dividend payment divided by the stock's price. A yield that's too high can be a red flag, suggesting that the dividend may not be sustainable. Remember, knowledge is power. Being aware of the potential risks and understanding how to navigate them can help you make more informed decisions and ultimately be more successful in your dividend investing journey. Being aware of these risks and knowing how to navigate them is crucial to successful dividend investing. You might be wondering, how does dividend investing compare to growth investing? Well, let's dive into it. Both dividend and growth investing are strategies employed by investors worldwide, but they each have their unique appeal and potential pitfalls. Imagine dividend investing as a reliable old friend. It's a strategy that focuses on buying stocks of companies that regularly pay dividends. These dividends are a portion of a company's earnings distributed to shareholders, providing a steady stream of income. It's like having a job that pays you even when you're sleeping. But this isn't a free lunch. The downside is that dividend-paying companies often have slower growth rates. They tend to be established and mature firms, which means they might not offer as much potential for rapid expansion or skyrocketing stock prices. On the other hand, we have growth investing. Picture it as the high-energy, high-risk cousin of dividend investing. Growth investors bet on companies they believe have above-average growth prospects. They're not interested in dividends, they're chasing capital gains, the increase in a stock's price over time. These could be younger companies, tech startups, or any firm with a promising future. The potential for high returns is alluring, but remember, with great rewards comes great risk. These stocks can be volatile, and there's no guarantee that a company's projected growth will materialize. So why might an investor choose one strategy over the other? If you're someone who values stability and a regular income, you might lean towards dividend investing. It's a great way to build wealth slowly and steadily. It's also a good fit for those nearing retirement or anyone who wants to mitigate risk. But if you're willing to take on more risk for the chance of higher returns and you have a longer investment horizon, growth investing might be your cup of tea. Remember, it's a strategy that requires patience and a stomach for market fluctuations. Of course, it's not a binary choice. Many investors choose a blended approach, combining elements of both strategies. They might allocate a portion of their portfolio to dividend stocks for steady income and another portion to growth stocks for potential capital gains. This balance can provide the benefits of both worlds: income, potential for high returns, and diversification to spread risk. Whether you choose dividend investing, growth investing, or a combination of both, the most important thing is to choose a strategy that aligns with your financial goals. Investing is a personal journey, and there's no one-size-fits-all approach. Your investment strategy should reflect your financial objectives, risk tolerance, and investment horizon. So take your time, do your research, and make informed decisions. Remember, the journey to financial freedom is not a race, but a carefully planned expedition. Now that you understand the basics of dividends, it's time to start building your dividend investing strategy. The first step in crafting a robust dividend investing strategy is setting clear and achievable financial goals. Think about what you want your dividends to do for you. Is it supplementing your income? Funding your retirement? Maybe it's providing a financial safety net? Your goals will guide every decision you make in your investing journey. Next, it's time to start selecting dividend stocks. Remember, not all dividend stocks are created equal. Look for companies with a consistent history of paying dividends and those with a sustainable dividend payout ratio. This is the proportion of a company's earnings that it pays out to shareholders as dividends. A ratio that's too high might indicate that the company is stretching itself thin, while a ratio that's too low might suggest that the company isn't fully utilizing its earnings. While it's important to focus on dividends, don't ignore the underlying strength of the company. Look at the company's financial health, its competitive position, and its ability to grow earnings. A strong company is more likely to keep paying dividends in the future. Diversification is another important aspect of your dividend investing strategy. Don't put all your eggs in one basket. Spread your investments across different sectors and industries. This can help mitigate risk and create a more stable income stream. Once you've built your portfolio, don't just set it and forget it. Regularly review and adjust your portfolio. This doesn't mean you need to be constantly buying and selling. Rather, periodically reassess your investments to ensure they're still aligned with your goals and performing as expected. In the world of dividends, reinvestment is a powerful tool. If you don't need the income right away, consider reinvesting your dividends back into the stock. This can significantly boost your portfolio's growth over time, thanks to the magic of compounding. Remember, patience is key. Dividend investing isn't about quick wins, it's about steady, long-term growth. It might be tempting to chase high-yield stocks, but they often come with higher risks. Stick to your strategy, and don't let short-term market fluctuations distract you from your long-term goals. Lastly, never stop learning. The world of finance is constantly evolving, and staying informed will help you make better investment decisions. Read financial news, follow market trends, and continually educate yourself about investing and personal finance. Remember, a well-planned strategy is key to achieving financial freedom through dividends. With dedication, patience, and a well-crafted dividend investing strategy, you're well on your way to making your financial goals a reality. Dividend investing is a journey, not a destination. It's a sentiment that resonates with every investor who's ever held a dividend-paying stock in their portfolio. If you've ever purchased a share of a company with the hope of receiving a regular income, you've taken your first steps on this journey. But like any journey, it requires two essential elements: patience and consistency. Let's talk about patience first. In our fast-paced world, we often want quick results. We're conditioned to expect instant gratification. But when it comes to dividend investing, patience truly is a virtue. You see, dividends typically aren't a get-rich-quick scheme. They're a way to slowly, steadily build wealth over time. Imagine a snowball rolling down a hill. At first it's small, barely noticeable. But as it continues to roll, it picks up more snow, growing larger and larger. That's how dividends work. You start with a small investment, and as you reinvest your dividends, your snowball grows. The growth might not be apparent at first, but give it time, and you'll see the magic happen. Next, let's discuss consistency. Consistency is the secret ingredient that makes the dividend investing recipe work. It's about making regular investments, irrespective of market conditions. When the market is up, you invest. When the market is down, you invest. This consistency allows you to take advantage of dollar-cost averaging, buying more shares when prices are low and fewer when prices are high. Consistency also means sticking to your investment strategy, even when it's tempting to veer off course. It's about resisting the allure of the latest hot stock or the panic of a market downturn. It's about staying focused on your long-term goals and not getting distracted by short-term market noise. Now you might be wondering, why go through all this trouble? What's the payoff? The answer is financial freedom. Financial freedom doesn't mean being a millionaire or billionaire. It means having enough income to cover your living expenses without having to work. It means having the freedom to do what you love, when you want, without worrying about money. And dividends can play a crucial role in achieving this. Think about it. A portfolio of dividend-paying stocks can provide a steady stream of income, even when you're not working. This income can be used to cover your expenses, allowing you to enjoy your life without financial stress. And the best part? This income can grow over time, thanks to the power of compounding. As you reinvest your dividends, you buy more shares, which in turn generate more dividends. It's a virtuous cycle that can lead to significant wealth accumulation over the long term. So, there you have it. The path to financial freedom through dividend investing. It's not a sprint, it's not a race, it's a journey. A journey that requires patience and consistency. A journey that can lead to a life of financial independence, where you're no longer working for money, but money is working for you. And remember, this journey isn't always easy. There will be bumps along the way, market downturns, economic recessions, unexpected events. But don't let these deter you. Stay the course, stick to your strategy, keep investing consistently, and let the power of dividends do the heavy lifting. Stay the course, and remember, the path to financial freedom isn't always swift, but with dividends it can certainly be smoother.